as you will see the remainder of this course, especially of course after your first exam, that's what we're going to do, okay? If you're going to go ahead to not managerial accounting, which is after this, if you're going to go ahead to intermediate accounting, 1 or 2, and anything else, accounting, after that you're going to do journal entries, okay? So if you're thinking about that as a major, please make sure you get this, because this is the foundation for everything. Really, everything you do after this, if you do journal entries, it's just going to be, does it fall under an asset, liabilities, or an equity account? That's why we always do this at the beginning, okay? So let's make sure that we have this locked in. Give me the balance sheet. What is the balance sheet? The balance sheet is what? What was that? Assets. Liabilities. Oh, I'm sorry. That's mine. Those are my points. Liabilities and what? Stockholders' equity, okay? And we always think of equity as ownership. So let's make sure we remember that's just ownership. Now, this is the balance sheet. What is the relationship between these? Assets equal liabilities plus equity. That is great, okay? Now, how many categories do we have for assets? 2. We also have 2 for what? And for equity. But remember that equity doesn't have anything really to do with the first 2 in terms of the categories. What are the 2 categories? We have what type of assets? All right, and what? All right. Current and long term. We also have the same categories over here for liabilities, right? Current and more of a long term. And finally, over here in the equity, we have what? Common stock and what? All right, retained earnings. So stock, common stock, and retained. Only reason I'm putting stock is because later on we're going to talk about a different type of stock that's going to be included in there. And just remember that stock is ownership. Everybody good so far? So we always list our assets in order of what? Liquidity. How do we remember that? They're crisp with a D. That's correct. Okay. So, and where does the D go? That's good. And that stands for debt investments. Okay. Let's go down the list. The C stands for what? Cash. R is receivables. I is inventory, good. Supplies. Oh, I'm sorry, I gave you another one. I bet y'all wish y'all was sitting there by y'all on y'all test, right? I'm bound to step up. Supplies and what? Prepaid, good. And of course, we have things like equipment down here. We have intangible assets. These are some things that we think about. Land, buildings, those are the type of things we have long-term assets, okay? They're not as important that you put them in a certain order. The reason we do this is because we want to say is how liquid is it, how quickly does it turn to cash. So that's the main reason why, okay? Now, going to our current liabilities, we know we have current and long-term, and then we have stockholders' equity and retained earnings. Now, if I had to say one of these was most important, it would probably be the balance sheet. But we have 4 financial statements, right? In order, they are your income statement, retained earnings, balance sheet, statement of cash flows, statement of cash flows, okay? So just kind of coming over here, we're going to be over here just because it's a little bit closer to this side over here. In our retained earnings, we have our retained earnings. It usually starts with what format? What do you have at first? I'm sorry, I like what you're doing. What you're doing is the income statement. So let's do the income statement first. I should have done that. I'm sorry. Your income statement. And your income statement, as you said, it has revenues minus the expenses, gives us our what? Our net income. Remember, you can't have a net loss, and that's always something a little bit different. Now, that we have this, our net income is going to flow into our what? Retained earnings. That's why we listed it in the order so we can remember it, okay? It's going to flow into your retained earnings, and you're always going to start off with what type of retained earnings? Last year's, I like that. That's like last year's is the same as beginning. It's beginning retained earnings. Perfect. The last day of the year, if it's December 31st, that's basically the same as January 1st. Okay, so that's why you said last year's. So last year's or beginning retained earnings. And then we're going to make 2 adjustments. One of them is going to be an addition of our what? Net income, because that's what we're not distributing. We are retaining it in the business. We paid all of our bills that we have, right? And in a second, we're going to pay our stockholders. So anything, but the stockholders come out of your retained earnings. Your income pays your expenses. So we're going to add our income, right? If it were a loss, what would we have done? Subtract, okay, as long as we know that. And then we're going to decrease our beginning retained earnings by the what? Dividends. Are dividends paid out of income? No, they're always paid out of retained earnings. And then I'm going to have finally my ending retained earnings. And that is how I get my statement of retained earnings. So that's why we always do it in that order. Any questions so far? Okay. Is it becoming more familiar to you, become more natural to you to say these things? I know you may say them in your head, but as long as it's starting to feel a little bit natural, okay? Now, we need to know how we're going to increase our assets, liabilities, and equity, because we want to think about recording them as we go. Journalizing, okay? So, how do I show it? Well, let me draw these things here called T accounts first, okay? I know I'm drawing a little bit different than, I don't have as much room today, but T accounts. And the left side of our T accounts are called what? Debit. The right is called? Which one means to increase? Neither. Who said neither? Perfect. Neither, because it always depends on which side it's on, okay? So our equal sign is going to be very important to us. If it's on this side over here, the assets, then we show our assets with an increase in what? Debt. That's right, okay? So I'm just going to put a plus here. How do I show an increase in liabilities? Meaning, oh, I have more bills to pay. How do I show I have more bills to pay? By credit. Right now, look, it balances. I have at least one here. And I know they're not value related. You can't have two categories over there, but in the end, as we saw the other day, there are going to be numbers that are associated with that, okay? And then finally, because our equity is on the same side of liabilities, that's going to increase with the what? A credit as well. When I'm showing it on my paper or on my computer, which one goes farthest to the left, the debit or the credit? The debit. And the credit we always indent a little bit, okay? Everybody, any questions? Not yet, if you're looking good so far? Okay, good, okay. All right, so now we're going to go ahead and go to the journal entries. I'm going to leave this up here, try to leave it up here so we can always kind of have something to refer to. I'm going to draw a line because I'm not necessarily putting them underneath there right now. Before we get started, I would like to go over a couple of concepts with you that are, one is definitely relative to this chapter, but the other ones are as well. It just looks a little bit differently. Let's say that you buy a house. How long is it going to take you to pay your house off? Doesn't matter. How long is it going to take you to pay your house off? 30 years? All right, anybody going to do it quicker? Okay, let's go with 30 years because I want to keep some of the money in my pocket, right? So we buy, don't pay attention to assets, liabilities, and equity. Don't really pay attention to this right now, okay? I buy a house. By the way, when I buy that house, I'm going to have a liability. But when I buy that house, it's going to cost me, say, how much? $275,000. Woo! We won't be living next door to each other. Mine $275,000. $275,000, right? Over 30 years. So we just divide it by 30, and you come up with some number, right? Now, we know that from right now, this day, let's just move back a little bit. January 1st, we have 30 years to pay it, right? But we have to pay some of that this year. So let's think back to what we had. We had current liabilities and we had long-term liabilities. When we record this whole $275,000 is going to go in what? We're paying it 30 years, so it's going to go in what? Long-term, right? But there's a portion that we're going to have to pay this upcoming year. They're not going to say just wait. They're going to say pay part of it this year, right? The part I pay this year must be recorded in our what? Long-term or short-term current liability? Long-term or short-term liabilities? Short-term. So even though I may have something that's long-term, I have to move part of that I'm going to pay within this next year to the current liabilities. Why is that important? Because, once again, thinking about liquidity. If I say that I have current liabilities of, I'm just going to say $75, right? But I know that I got to pay $25 something else. Then technically I have liabilities of what? $100. So we want to be, I hate to say honest, but we want to make sure that we disclose things properly. The reason I say I didn't want to say honest because it's not like you're trying to be dishonest. Sometimes you just don't know, okay? Because all we've seen so far is this is just long term. But there's a question that has to do with accounts payable in at least one of the ones, I think it was similar to what we did last time. So that concept is going to go up. And what that means is that you'll have to read your question. For example, on this one here, you have a bunch of statements here about what you owe and everything. But at the bottom, it's going to say a portion of this notes payable, or this right here, is going to be short term. So we understand that even though something can be 30 years or 5 years or 10 years, the part we got to pay right now must be classified as what type of liability? A short-term liability. Current liability, short-term liability. That's correct, okay? So everybody good with that statement? Everybody good with that concept? Okay. Let me go over another one right fast. I have 1, that one doesn't count, 2, 3, 4, 5, 6 markers, right? That's the beginning of the year, per se. That's the beginning of the year. I have 6 markers. Now, when you buy these markers, let's just say they all cost $1 a piece. You're going to buy them at the beginning of the year. And are these your supplies or inventory, by the way? Supplies versus inventory. Are these markers supplies or inventory in terms of what I do? I teach, right? So are these my inventory? Is this my inventory or are these my supplies? Supplies, because that's what I use to kind of get the product sold. The product is education, right? So I'm going to record my supplies with a debit, right? And I'm going to record, let's just say I paid them, let's say I paid some in cash, or let's just say accounts payable, even better. Accounts payable. Doesn't really matter if it's supply, which one it is, but instead of just putting a generic number, let's just say 6, right? $6. So we're good with that one. This is my asset, right? Supplies is an asset. Supplies is an asset. What is an asset? Something has a probable future economic gain that's associated with it, okay? So the gain is that we're going to sell this education, right? That's my asset. Now, what about when I use one of these markers? Now, this is what I have from last year. This is what I have in the beginning. I need to go over here and get one of these supplies out to be able to do my work, right? So we agree that I reduce my supplies a little bit, right? So now, since I reduce my supplies, and since supplies is an asset, am I going to debit or credit my asset that I just reduced? We had 6 markers at first, right? We agreed we had 6 markers, and we put them on the books at $1 a piece in terms of a debit, right? When I take one of these out, I've now taken out one of my supplies, right? What do I do to show I took out one of my supplies? Do I debit or credit? Credit. Everybody agree that I credit supplies? And does it make sense in terms of why we're doing it there? Okay. So I'm going to credit my supplies. I took one out. For $1. Of course, we know this is going to have the balance, so we put that there. Now, I'm going to have to also have a debit. What do you think that debit is going to be? You might not know this yet, but that debit is going to be supplies. I'm going to abbreviate supplies expense, okay? Supplies expense. When I see expense in front of the word, it's usually talking about I used up some type of asset, okay? So if I have supplies expense, what asset have I used up? The markers, right? So supplies expense says that I used up the markers. I had 6 at first. That is my journal entry. I had 6. I increased my assets, right? And I paid them cash or whatever, it didn't really matter. But when I use one of them up, I use a supply. If I put it on the books as a debit, I take it off as a what? As a credit. And then I show that I've increased my expenses by debiting those. Is everybody good with that part? Okay. Now, I increase my expenses. This is something you just write down for yourself. Don't worry about this for the exam. An increase in expenses is a decrease in equity. Does that make sense to you? Okay. An increase in expenses is a decrease in equity. Why? Because we generally increase our equity over here. So anything that decreases it will go on this side right here. So that's why we have that there. Okay, that's not on your exam, but that's just I wanted to put that part. But this is going to be very important. Yes, ma'am.
So the supplies for the account, the one that's in blue, the supplies is on the top further to the left.
Further to the left, that's right.
For debit, while the other supplies is more so to the right on the credit.
That's right.
Is the reasoning behind that is because the first supplies is you are getting the supplies, but you're minusing your account.
Let's put it like this. When I got those supplies, even like we're gonna measure this is split. This means I put 6 markers over here in my storage, right? I put 6 in my storage. To show that I put things in storage, I had to debit that because I increased my what? My assets. So what this means is that I have an increase in my assets called supplies. Let's say it's inventory. If I was buying computer boards or whatever, if I'm buying a computer board, that's an asset. That would be an inventory thing. How do I show an increase in my inventory asset? With the what? Debit. With the debit. Okay. Now, once I sell that inventory, how do I take that inventory off of the books? Credit. With the credit. And so that's why I come over here and indent right here.
Okay, so it just doesn't matter what it is. You can just go whether it's increasing.
That's correct. That's exactly right. Because what we're going to see later on is we're going to see some brand new accounts, okay? And I like how you said it doesn't really matter what it is. It's just where it goes. Because if we had an asset, shoes. I need some new shoes. If we had an asset called shoes, right? It's still an asset. So if we get to chapter, obviously we don't have 19 chapters. If we get to chapter 19 and you see shoes for the first time as an asset, then you know that every time you buy shoes to sell, that is going to go over here and we're going to increase it. Okay? Can I give you a little bit more to just make it a little bit differently? Let's say that this is going to drive home your point. Let's say that when I bought this on accounts payable, that I paid $5 off of that I have $5 of a liability. That is correct, right? I have $5 liability. What am I missing? How much am I missing? $1. Let's just say that I paid that off by giving them an asset called shoes, right? That is all we need to think about is it an asset, liability, or equity? So it's shoes. You see, I'm reducing my assets because I'm giving them the shoes, right? I could have given them cash, but they said, hey, I'll accept shoes. Or they said, hey, I'll accept candy. Whatever the asset is they accept to pay it off is a reduction in the asset. So whatever new accounts you have, think of it as asset, liability, or equity. Does that kind of make sense there? Everybody okay? Okay. I thought you raised your hand, okay. Any more questions? All right, we have one more. It is on this one. Part of it is on this example we're going to do, but I'm going to go over it first. It doesn't go in this much depth. Prepaid assets is an asset, liability, or equity. Prepaid assets. Prepaid insurance is assets, okay? Prepaid insurance, okay? Prepaid insurance. We agree that is an asset, right? Okay? We just, basically when you have prepaid anything, you're just paying up in advance. Let's say I paid my insurance at the beginning of the year. That's a pretty good thing. Well, I probably could have used money for something else, but let's say that I didn't have anything else to use it for, so I said, I may as well pay my insurance up so I don't have to worry about forgetting later on. Is that okay? Everybody okay with that? This is why, okay, so at this point in time, we have an asset of, let's say $1,200, okay, for the whole entire year. $1,200. Okay, that is going to be $100 a month. We agree? Okay, now, this is an asset. At the end of this month, I'm going to have, let's not talk accounting, let's just talk in general. I paid 12 months at the beginning of the year, right? So I paid up in full 12 months. At the beginning of February, how many more months of coverage do I have? 11, okay? So that means I used up at least 1 month of insurance. Everybody okay with that? Now, since you're okay with that, prepaid insurance is a what? Asset, liability, or equity? Asset. So how do I show that I used up some of this right here? Do I debit or credit that account? It is an asset. I credit it. All I want to know if it's an asset, right? So I'm going to credit it to show that I use it up, okay? I'm going to have to abbreviate just a little bit more so I can have space. Prepaid insurance. And I'm putting in parentheses A for asset. Now, usually an expense is going to be something that you use, okay? So we used up this right, we used up this right here, and we're going to have this thing called insurance, not prepaid, but this is where the account will be a little bit different. Insurance expense for the amount that I used up that first month. But the main thing I want us to see is that even though this is an asset, when we use up that first month's worth, I need to do what? Show that I've taken it off the book. Show that I use it up. All this is a picture. So how do I show that this has been used up? I credit it instead of debit it. Is everybody okay with that right there? All right, nod your head if we can keep going. All right, and the last one's going to be easy. I just want to just point something out to you. Accounts payable is always liability. Accounts receivable is always an asset. You're going to see a word on here called on account. If I sell you something, let me change around because I want us to remember that this book is always from the company perspective. So if our company sells somebody something, then they promise to pay us. Is that accounts receivable or accounts payable? They promise to pay us. So is that accounts receivable or accounts payable? Receivable, right? So when it says something like purchasing, perform computer services on account, I went in and did all their work for them on account. We went in and did their work on account. They're going to pay us. Think about it. They didn't cut us a check now, but they'll probably cut us a check Friday. So right now, we can record an accounts receivable. Okay, so when we're doing work and someone's going to pay us, that's an accounts receivable. If we buy some stuff on account, then that's an accounts what? Payable. Okay, so just remember those two differences because that on account is going to, that's one of the terminologies that may kind of get you sometime, okay? So let's go ahead and start. We're going to start with exercise 13-3. Exercise 13-3. It's going to be loaded up there in a second. While it's loaded up, I'll go ahead and tell you, basically, this is journal entries. As you prepare for your exam, please do as many journal entries as possible. There is going to be a problem just like this on your exam. But think about it. Can there be anything else but something like this? Because you can only show journalizing by journalizing. When you get to your exam, I would encourage you to write what we wrote up there at the top. Write assets, liabilities, plus equity. Write your little plus sign there in terms of tells you which one it goes up under. And then go with your accounts. If you need to list some more accounts, list those just to remind yourself of what goes there, okay? When you get your scratch paper, please, if you can, write that up there. That will save you. It'll get you out of trouble sometimes, okay? So the first journal entry we have is to purchase equipment on account for $9,600. We, our company, is going to purchase some equipment on account for $9,600. First of all, we're purchasing equipment. Equipment is an asset, liability, or equity. Equipment is an asset, liability, or equity. Asset, right? Good. How do we show an increase? Do we agree we are increasing assets? We agree with increasing assets, right? So how do we show an increase in assets with the what? A debit to assets, a debit to equipment, okay? So equipment is going to be debit. Now, are we paying for this equipment with cash?
No.
No. We're paying for it what? Use these words right here. We're paying for it what? On account. I want to get used to seeing it, okay? So we're paying for it on account, which means I have a what? Accounts payable, which is a what? A liability, okay? So how do I show an increase in liabilities with a debit or a credit? Or what's that? Is it with a debit? Nod your head. Is it with a credit? Nod your head. Good, there we go, okay? Accounts payable. For $9,600. So when you see your problem, we're not going to have no more than 3 lines, in most cases 2 lines for a journal entry right now. Just go ahead and be like, this is a something or this is a something depending on what it is. In this case, this is an asset and this is a liability, okay? Everybody good on that? Any questions? Yes.
So whenever it says on the account, that's always going to be account payable?
It may be notes payable, but it's going to be some type of liability. If it's something that's going to be long term like that, example I talked about earlier, mortgage payable, or even I think on the previous homework, notes payable. Usually, if it's long term stuff like that, it'll be notes payable. But the key is make sure if you pick either one, that it's going to be a liability. And then, like I say, most of these are going to be accounts payable. If it says something about notes payable, you just know to use notes payable. Usually they're going to specify, this early on, they're going to specify which one it is, okay? Later on like the third exam, we'll start talking about something a little bit different. But right now, it's going to specify notes payable. Everything else, when you see it on account, 9 times out of 10 is going to be accounts payable, okay? Yes, ma'am.
Just one more
Uh-huh.
question that came from it. So I noticed you said account payable, that's a liability, but is it on purpose under the assets, or is it just?
No, this is. I didn't want to erase this because I was to always keep this in our mind. This is something this is just for us to just like that little cheat sheet on our paper we're going to write. This is just for us to think about.
Okay,
Yeah.
I see the line now.
Oh no, let me make it darker.
So it's all just gonna be an up and down line, no matter if it's an asset, liability, or equity.
That's correct. This is going to be my paper right here. That makes it look there we go. Okay. That's pretty good. It's not a straight line though. Okay. Everybody good? Can we keep going? All right. Next, we're going to pay. We're going to pay $2,000 for rent for the month of May. Notice that this company, as we see, Peter Computer has the following transactions for the month of May. So for the month of May, for May's rent, we're going to pay how much? $2,000, okay? Think about it for 5 seconds. What do we have? We're dealing with definitely what? If you just give me one of them, I'll be glad right now. We're dealing with what? A rent expense. Good. And are we paying that with cash or on account? Cash. If it doesn't say on account, it must be cash, especially right now. I mean, there's no other way we can do it. Obviously, there's something else, but if it doesn't say anything else, it's always going to be cash, okay? So we have a rent expense that we are paying with cash. Which one's the easy one you want? It doesn't really matter which one you do first for me right now, but which one do you want to do first? Which one you want to get out the way? The cash or the rent expense? Aren't we experts on cash now? So how do we show a decrease in cash? With a credit, right? So let's just get that out the way. See, even though I'm writing it first, it doesn't matter which one I write first, as long as I remember to indent it, okay? So it is cash. I guess I'll try to stick with the same marker there. Cash for 2,000. Yes, right. That's correct. Okay, 2,000. And I have an expense, rent expense. We show an increase in expense. Oh, can you see everything over there? Okay. So we have rent expense, right? And our rent expense, it has to be debited, okay? It has to be debited. What expense are we using? What we're renting. So that's what we call it rent expense, okay? So rent expense will go here. For saying 2,000. Is everybody good on that part? Any questions? Can we keep going? Shake your head yes if you can keep going. Okay. Before we keep going, I'm just helping you study, okay? Let's just say that we only paid part of this. Let's just say we only had, only is a lot, but let's say we only had $1,500. Then we would still owe, correct? So that means we will have what here? A what? A liability, because we will still owe. It may be rent liability, but some type of liability will be credited right here for the remainder. This is just a for if to help us to study, okay? It would be, let's just call it, usually what you pay, the liability is going to have that name, we would have that $500 there. So you see how that makes a difference? Like I said, this is not part of the problem. This is just so we can just, just makes us think about what we're doing. So we won't get caught up in, because sometimes you can look at these accounts, and after a while, you're going to automatically say, I know this, especially when you do this problem 2 or 3 times. You're going to automatically know, but you want to step back and just kind of think to yourself what would happen. That's another way of studying, okay? Even though I have 2 separate things here, and even though I just made this up different from the book, my debits should always equal my credits, right? Debits should always equal your credits. That is a double-sided interest system. My accounts may be wrong. Actually, my amounts could be wrong. But one thing should be right, and that's going to be my sum of my debits, my sum of my credits. That's going to help me at the very least. If this is wrong, I guarantee you can go back and find one of these wrong, or you may have typed 501 instead of 500. Okay, so always make sure that they are together. Everybody still doing good? Did y'all see that quarterback commercial after he won the game on YouTube? I think I talked about it the other day, right? That's pretty neat, right? Taking his name, and I bet they were sad, right? But the other quarterback, is he the greatest yet? Is he ever going to be the greatest? That's right, because he don't play for the Bills. That's my team, you know what I'm saying? Perform computer services for $3,800 on account. Remember, all of this has to do with our company, so we have to look at it from the company standpoint, okay? So we perform computer services on account. We perform computer services on account, okay? So what do we have here? We have something that is done on account. That means that they're going to do what? We expect them to do what? Pay us, right? We expect them to pay us. We perform them on account. Now, we expect them to pay us. Usually we would debit, if they had paid us, we would have debited cash, right? We agree? But since they did not pay us, then we're going to receive a promise to pay, which is called what? Accounts receivable. Good, okay? Accounts receivable. Now, is accounts receivable an asset, liability, or equity? Even if I had a mistakenly credited, it's still an asset. It doesn't change even though you make a mistake. So that's why we must make sure that we understand that this is going to be an asset regardless. As we talk about a second ago, that's the character of it, okay? But we show an increase by the debit, okay? So accounts receivable is an asset. Now, did we complete the job? We completed the job, right? So we earned some what? Revenue. How do we show an increase in revenues? How do we show an increase in equity? Makes sense how it all goes together? That's why we came over here first and did the income statement to show how it flows into there. So we're going to go ahead and record our income or our revenue here. I think it was $3,800, right? And that's what we have. Does it make sense why we credited our revenues, right? Does it make sense? Let me just write this again. This is just for us to Remember what's going on here? Now I am going to use this for a second, okay? I'm going to use this right here. Equity. We show increase in equity with the what? Credit. Increases equity. So anything that increases equity is going to be what? Credit. My revenues increase equity. So I'll show an increase in revenues with the what? A credit. Now, for my expenses, do expenses increase or decrease my equity? Do expenses increase or decrease my equity? If we don't know nothing else, we know revenues increasing, right? So that means that expenses have to do what? Decreasing. Just going down here, how do we show a decrease? With a debit, okay? Is that okay? Everybody okay with that there? Okay. So yes, ma'am. So what this does, it just gives us a model. Once again, part of your cheat sheet that you can write on your exam. Yes, ma'am.
So for the account receivable, the revenue is whenever the job has been done. What is it if you've not done the job yet?
We're going to get to that in a second, but I'm glad you asked because it can be very important. I'm going to modify this, okay? I'm going to modify this for that question because this actually goes along what we talked about at first. So I'm going to modify this. Is everybody okay with that? Okay. Her question was, what if we didn't finish the job? I'm going to change your question a little bit. What if we completed half of the job? Is that okay? Because we completed half the job, right? If somebody comes to do some work on your house, they're probably going to get half the money, at least at first, okay? Right? So if we completed half of the money, half of the job, then that's going to be how much? We did computer services. We did half of that program. How much have we completed? Half. So we're going to have revenues in our hand of how much?
1,900.
1,900. Okay. And I may have done. I think I did this a little bit different. Let me see. Yes.
That's 1,900.
1,900. Okay. Now I'm going to change this to cash. To say that they paid us up front, okay? Because I think that'd be a better. This is usually when you have unearned revenues. With unearned revenues, you're usually going to get cash in your hand at first, okay? They're not going to promise you nothing if you haven't given them anything, okay? So we're going to call this cash. This says that we received cash of $3,800, and we did half the work. Revenues. Revenues is an equity item. We agree, right? Now, if we leave the company or if we shut down, we need to either give them some money back or we need to go ahead and finish coding. We agree? So until we finish everything else, have we earned revenues? No. These would be called what? Unearned revenues, okay? So unearned revenues at this point in time is what we would have for the remainder. Unearned, this is a debit, this is a credit. Okay. That's a credit. Unearned revenues is a liability because that's what we owe, that's what we continue to owe them, okay? So that's just modifying it because that was a good question. What if we hadn't completed the job? Usually if you hadn't completed the job and they gave you cash, that's the reason you have to record unearned revenues. Like when you buy your season tickets. The stadium will have your money and they owe you a game, in the case of Dallas Mavericks, a product or a refund, okay? So what they owe you something. So that's why you have this. You can either give them $1,900 back, they can go find somebody else, or you can go ahead and finish the job. Hopefully we'll be able to finish the job as we start. Okay? Is everybody okay with that one? Let's continue. We can put a we in front of this. We paid Buffalo Hydro $400 cash for utilities. We paid this, okay? This is our company. All of these examples, all of these questions, this whole book is about the company. So let's make ourselves the company, okay? We are paying $400 cash for utilities in May. I'm gonna give you a second to write that down, okay? Then we're gonna see if you're okay. Are we going too fast? Are we going too slow? Everybody okay? Okay, I got time, I just wanna make sure, that we're okay. We paid Buffalo Hydro $400 cash for utilities, okay? What's that journal entry going to be? We're going to debit utilities expense, because an expense is a using up of something, so we're showing that we've used up utilities. And we're going to credit what? Cash. For how much? $400. Everybody okay with that one? Okay. What if I hadn't paid that yet? Then that would be a what? Would it be an asset if I had not paid it yet?
It'd be a liability.
It'd be a liability. So I have some type of payable here, probably utilities payable, okay? I'll have some type of utility here, and more than likely it's going to be utilities payable. I'll have a liability. So if you see how that works, if I had only paid $100, then I would have a liability of how much? 300. Like I said, a utility, it would probably be called utilities payable. Okay? So everybody good? That's just a modification for our study, okay? Everybody still good? All right. Now, our company, are going to borrow $22,000 from the bank. Why are we borrowing $22,000? What would you do with $22,000 if you had it? Right now. Buy a car. That's one less thing you got to worry about. Anybody do anything different?
Save it to pay off college debt.
Save to pay off college debt. Not bad. Yes, ma'am.
You can always invest like a portion of it into something and then save the rest of it just in case you need it.
That's pretty good. You changed the question around. I like that, because now you think about that journal entry a little bit different. Okay. When she said invest, I'm going to put y'all's two ideas together with your car. If you wait to pay, this is just us talking. If you wait to pay it off, it's fine. If there's an interest component that's steadily building, you probably want to pay it down a little bit right now, just to avoid that interest. That's the only thing about it. But if there's no interest attached to it until later on, hey, just wait. Same thing, car. If you want to go ahead and knock it out, think about how much money you will save by paying it off right now. You want to pay 30-year house note. That house note is 30-year. You're going to pay your house note 30 years. If you wait for 30 years, you're basically paying double of that house. So if you have that $22,000 paid off like our car, or get an interest-free one like his house, like your college loan, do one of those right there, okay? And if you can't, just invest in something that makes higher return than your interest, okay? So we got this $22,000 to do those three things with, okay? You three got $22,000. No matter who got it or what you're gonna do with it, how do we show the cash that we got from there? Are we going to debit or credit cash?
Credit? No,
Maybe
debit.
debit.
Okay.
Since we're receiving the cash from the bank, wouldn't it be a?
There you go, Sid. I wait for the explanation. The only reason I wait for the explanation because I heard different ones. So that's how you justify your own answer. Yes, because we received, this is our business now, because we received it from the bank, then we're going to debit the cash for $22,000, okay? Now, did it say the bank gave it to us for free? It said it did what? We borrowed it, or they loaned it to us. So that means we have now established a what?
Liability.
A liability called note payable, okay? A liability called note payable. In this case, like we say, for the same amount. Yes.
So the account payable, where it says up there how we purchased it on an account.
Which one, wait, which one, which number, please?
Number one.
Number one. There we go, gotcha, okay? That's all, folks. I'm gone.